Welcome to Bruce Hurwitz Presents Meet the Experts. I'm your host, Bruce Hurwitz of Hurwitz Strategic Staffing. You can find us on the web at hsstaffing.com. I hope you'll consider us for all your staffing, career counseling, and professional writing needs. I am delighted to be joined today by Robert Klausner. We will be discussing 2022 tax planning. Rob, welcome to the show.
Morning, Bruce. Thank you for having me.
It's my pleasure. Take a minute or two and introduce yourself to our viewers.
Sure. My name is Robert Klausner. I'm a tax partner at P&K CPAs located in Parsippany, New Jersey. We're a medium-sized firm that handles all tax accounting and auditing needs of small and medium-sized businesses. We handle business consulting for small businesses and help people work on their taxes and work on save the money that they're entitled to.
I don't know if I ever told you this, but many years ago when I was involved with the Manhattan Chamber of Commerce, I was emceeing, I guess you could say, a panel on taxes. It was a boot camp for startups. And this one woman raised her hand and said that she was concerned she was going to have her best year ever. She was going to be making more than $10,000 in revenue. And her friend had told her that if you don't have $10,000 in revenue, you don't have to file your taxes. So she hadn't filed any taxes for 10 years. And everybody sort of went white. And the general consensus was you don't get advice on taxes from friends. So I'm glad you're here.
Not the best idea.
Even though we're friends, you're still a CPA. Now, here are the topics that we will be covering, and let's just take them one at a time. Business alternative income tax. Now, I hate acronyms. But here we've got BAIT. And when there's a BAIT, there's a switch, usually. So what's the BAIT and is there a switch?
So the BAIT is the New Jersey acronym, as it says there, the Business Alternative Income Tax. And this was all in response to the 2018 capping of the tax deduction on your Schedule A for individuals. Everybody has what's given. Normally, you were able to deduct your state and local income taxes, your real estate taxes on your tax return. In 2018, when President Trump changed the tax law, they put a cap of $10,000 on that deduction. So if your real estate taxes, and here in the Northeast, we have the highest real estate taxes in the country. Most people's real estate taxes are over $10,000 right away. So then you're losing all your state and local taxes that you were able to get. So this was a provision that states and many states now have followed suit. New Jersey's is called BAIT. The other acronym there, the PTET, is a pass-through entity tax. That's what a lot of the other states use because this is only available to people who have pass-through entities, either an S corporation or a multi-member LLC. So this, what it's allowing the entities to do is to admit, and it's an annual election. It could be passed on, not done or revoked, but it allows you to figure out based on your income from that entity, we'll use New Jersey as the example, what the New Jersey tax would be on that income alone. It's not your other income, and you can't overpay. You can't say, oh, I'm going to pay him $50,000. So if your income, as an example, if your income in New Jersey on your K1 coming from the S corporation or the LLC is $100,000, the New Jersey there's groupings that start at 5.65% and increase from there. But so the tax on that would be $5,600. That $5,600 can be paid in by the S corp or the LLC as an estimated tax on a quarterly basis. and deducted from the income of the S Corp and the or the LLC, passes through to the individual as a tax credit on their individual income tax return as if they made an estimated payment. So in essence, it's allowing them the deduction for the taxes.
Sorry. Now, the next topic is I always get choked up when I'm about to talk about retirement updates.
Right.
So what's new with retirement updates? And I'm not trying to be funny, but I see these advertisements happen for the last week or so about Bitcoin and retirement planning.
I will not comment on cryptocurrencies. I'll say I don't have enough information about them. I don't trust them. I don't believe it's a stable investment, or there are risky people that like to do it, and we've seen the bottom fall out of the market in the last year, and a lot of people have lost a lot of money doing it. So I wouldn't recommend it for your retirement plans. The retirement update, there hasn't been any changes other than back in 2021, they did raise the retirement age of required distribution from 70.5 to 72. So you have until age 72 to start taking required minimum distributions from your retirement plans. So that's been the only change. Other than that, there's been normal increases to the minimums. In 2022. You can put away $22,500 into your 401k plan or 403b plan, which is up from $20,500 in previous years. The catch up for most of it has been $6,500. That they haven't changed. So that if you're over 50 years old, you're allowed a $6,500 catch up. So you, in essence, for 2022, you could put away $29,000 into your 401k if you're over 50. IRA contributions remains unchanged, still $6,000 with $1,000 catch up if you're over 50. And that it's going to go up $500 in 2023, but it's not going to do much for anybody else.
Now, if you take out, I'll just share the screen again. If you take, you're able to take out money from your retirement plan before 72, how old do you have to be to withdraw from a retirement plan and not pay a penalty?
Good question. So that is age 59. So if you put money into any of these types of retirement plans, IRAs, 401ks, etc., you must reach age 59. After 59, you can start taking distributions at your discretion. They will be taxable as ordinary income, but they will not be subject to penalty.
So tax brackets and standard deduction adjustments. What do we need to know?
So these are just the normal annual increases for income. There's been slight increases across the board. It's difficult to really discuss as far as that goes. The standard deduction is increasing from 25 for married filing joint. Last year was $25,100. This year it's going to, in 2022, it's going to be $25,900. So it went up $800 from the previous year. Same thing with the other brackets. The standard deduction increases every year because a lot more people are not itemizing because of the aforementioned BAPE and PTET issue. The cap on the state and local taxes that has really pushed a lot of people into standard deductions over the last couple of years, where they were previously itemizing. If you're still a heavy contributor to charity, or you have high medical expenses, then you could still itemize, most likely. And it's always important to know that your medical deductions, you should always look at the out-of-pocket medical deductions, because what may not be deductible on the federal could be deductible on New Jersey, where it's a much lower limitation. So on federal, there's a 7.5% of adjusted gross income limitation. So again, if your adjusted gross income is $100,000, your first $7,500 of medical will not count, but then the rest, anything over that, would be deductible. In New Jersey, it's only a 2% limitation. So it's only the first $2,000. So it would be easier to handle and to get a deduction at that level.
Good to know. Now, gift and estate tax, what's new?
So this is for all those people that have, everybody has a lifetime exclusion for their estate. The gift and estate exclusions are tied. So over your lifetime, you can gift at the moment, it's $12,060,000. So anybody so before you die, give it away.
12,060,000?
That is the 2022 number.
Why such a idiotic number?
Well, it started out when it was adjusted several years ago. President Trump doubled it to, at the time, it was $10 million or $10.5 million. Because when President Obama was in office, it was like 5 million, 5.5 million. And then he doubled it to make it 10.5 or $11 million at the time. So it's been going up for inflation over the last several years. It gets up, so it's right, becomes an odd number. But this is set to sunset this exclusion in 2025 unless another tax act is put in place to either extend it or change it. So it was widely believed that it was going to be lowered back to the $5 million. You know, some of the states have followed suit and follow the federal. Some of the states do not, like New York does not follow the estate, and their estate limit is still around $5 or $6 million.
And finally, the topic that I'm most interested in is tax planning. Now, every time I speak about planning, I always begin with our old friend, General Moltke, who said that no plan ever survives first contact with the enemy. Now, you know, by the 15th of January, more or less, what the tax laws are going to be. So you can...
Most of the time. There have been tax acts enacted where they have gone retro, and they've been enacted later in the year, and then they go back and try and put them in for the following, you know, for that particular year. So it depends, but yes, like as of today, like there's going to be no changes to the tax laws for the remainder of this year at this point. The tax forms are set, the programs are in place. So unless there's nothing beyond before Congress for extension, or it would have been done already. So you do know it's better to start looking at it. Like right now, we're in the middle of doing all of our planning. I'm contacting most of my clients to see if they want to look at year-end planning to see if there's been any significant changes. People often don't think, oh no, it's the same as last year, and they find, oh wait, there was a big stock sale back, and now this year's market's been a little down, so it's probably not going to be a situation this year. But there has been situations where people said, oh yeah, no, I don't have anything, and then they come in February, they're gathering all their documents, and they find that they had a big stock sale or gain in something that occurred at the beginning of the previous year. What can we do about it? And you can't do anything about it. If you don't look at it before year end, once the year closes, everybody and all individuals are cash basis taxpayers. So anything that has to be done before year end in 99% of the situations.
So what I'm hearing is that as long as you report everything honestly, emphasis on honestly, then you should be okay.
Well, you have to plan for it, though. You still have to know. People often don't realize they have, again, capital gains or everything. When the market was running big last year, a lot of people had significant capital gains because their brokers were trading their accounts and making lots of money and want to show them how good they are. So we got to do their tax returns, all of a sudden there was a big capital gain, which triggered a big tax bill, and they didn't understand why. I don't have that money. It's in the account. Still made and then since then, by the time we were doing their tax return, obviously the market had started dropping this year, and those gains had erased. So now they're paying tax on gains that no longer were available. So,
I misspoke. What I should have said was, as long as you report everything honestly to your accountant.
Yes.
then you should be okay, because
Yeah, and you communicate. I try and communicate to people, like I said, throughout the year, because it's important to know what's going on, and to look at things. It may be simple. A lot of people worry about some accounting firms all bill, you're supposed to bill your time every 15 minutes. And some accounting firms will bill their clients for every call or email or whatever. That's not how we operate. We work with our clients very closely. It's important for them to succeed so we can succeed. So we work with them throughout the year. And if there's a special project, we let them know. But otherwise, everything's included as far as we do it. And we try and work to make sure that they are covered. They take advantage of any possible tax law or tax savings that are available, such as the pass-through entity tax. We have many clients have done that. Setting up, if they have a small business, they can set up a pension plan, a 401k, cash balance plans have been very popular for some of my smaller clients that have been doing that in order to save some money.
it's 2022. Do people still bring you shoe boxes full of receipts?
No, well, so there are some old school people that still do try and bring in every slip of paper, every receipt. We tell them to summarize it and give us the number. We are not auditing them, so it is up to them to give us the totals and review it and then let us know. So it's
I was absolutely shocked. I went into Staples a couple weeks ago, ironically, to buy a stapler. And as I was walking up and down the aisles, just out of curiosity, I saw two ledgers. I didn't even know they made ledgers anymore.
the green bar of paper.
Yeah, yeah.
There's still a few old school people that still do and do things by hand, and then we'll go out and use that ledger. It is surprising. We are trying to move as paperless as possible here. We have secure file portals that we use to exchange documents with our clients, and try and push them to be as technological as possible. Some embrace it, some do not.
And it's easy. It's easy. Now, I'm going to share the screen again because I want to provide our viewers with your contact information. And my last question for you is there anything that I didn't ask you that you wish I had asked you? And if I had asked you, what would you have said?
You didn't ask me if the Giants are going to crush the Detroit Lions this weekend, which I believe they are. So then to push them into.
So you're not, your company is basically located, you accept clients throughout the United States, but not Michigan.
Not Michigan. No, we'll take them. They need help too.
Yeah, but they're not going to come to you.
We have clients all over the country and actually out of the country as well. We are a small firm with big firm experience and knowledge throughout. So I would encourage anybody to seek us out for assistance.
Now, if somebody were to bet on the game and they were to lose, they can claim that on their income tax, correct?
Only if they're a professional gambler. That's the only way. But you never know. I've seen worse.
Wait a minute. If you go to Atlantic City, Las Vegas, whatever, and you lose $500, you can't claim that unless you put down as your occupation that you're a gambler.
So if you win, so you hit if you hit either the lottery or you hit a slot machine for $5,000, but you have losses during the same year,
Mm-hmm.
that you can prove. Again, usually that's why all the casinos have tracker cards, loyalty cards and whatnot. So they could tell you. So if you win on a slot machine and then but you've been there, you go every month and you've lost more than that. So if you itemize, because the gambling winnings will be reported on a 1099 or W2G, and then the gambling losses do go on Schedule A, and they are not subject to any limitation, but you do have to itemize in order to get the deduction. So if you are, depending on what the amount is, you may or may not be able to claim the losses. And you can only claim losses to the extent of your winnings. So if you had $5,000 of winnings, but you had $10,000 of losses, you can only claim $5,000 of losses to offset the winning.
Understood. Rob, thank you very much for coming on. I greatly appreciate it. And always, you've provided a wealth of important information.
My pleasure, Bruce. Thank you very much.
I wanted to thank everyone for watching. I want to wish everyone a very good, very happy Thanksgiving. And as always, please stay focused on success.